Hello, everybody, and welcome to Asymmetric Investing's live monthly AMA. I am Travis Hoyam of Asymmetric Investing. If you are not familiar with me, writing about all of my investments on the Asymmetric Investing newsletter, and then covering a lot of those here on YouTube as well. This is a chance to kind of talk about some of the stocks that I'm talking about every single month, that I'm doing research on, that I'm potentially buying in the asymmetric portfolio, and just kind of get your thoughts. And so I have a bunch of questions here that I asked people to send in from the newsletter. But if you're watching on YouTube or on Twitter or any place like that, feel free to get those questions in, and they will come up in my little platform here, and we will talk about all things investing. So I wanted to first start with just kind of some of the weird stuff that's going on in the software business today, because I think this is where we're seeing a huge dislocation. If you just look at what's going on in the S&P 500, it doesn't look like there's a lot going on in the market right now, but underneath there's a ton of companies that are down 50, 60, 70, sometimes 80%, and their business hasn't really changed that much. And these are the kind of opportunities that I'm always looking for as an investor. If you have a company that's compounding revenue year after year after year, your Netflix, your Amazon, your Nvidia, typically those discounts are really good times to buy a stock. The question is, what's the difference between a discount, a dislocation where the market is getting it wrong, and what's something actually fundamentally disrupting these businesses? And as we look at a lot of these software names that have been down, I'm going to use Duolingo as an example, and I'll pull up some of their financials here in a second. But they are down about 80%. I think the stock's down like 5% today, but the current drawdown, 77% as I'm recording right now. So it's just crazy. Price earnings multiple on a trailing basis is now just 17. I think that includes some one-time benefits, but even if you look at price to free cash flow, that's only 18 times. That is nuts for a company that over the past 3 years has grown revenue at a 42% compound annual growth rate. So there are opportunities in the market. We just need to decipher what are opportunities and what are falling knives, if you will. And one of the things that I've been thinking a lot about is the disruption from artificial intelligence. What's disruption and what's not? Is I think we need to look at companies that have lots and lots of customers. And are those customers all going to be able to create their own alternative? Or is it worth even thinking about creating your own alternative when you've got something that's available for $10 a month, for $20 a month? You know, I'm not going to vibe code Netflix. That's a idiotic concept. I think it's kind of the same thing with Duolingo. Most of the people who are using Duolingo and Luis Von On, if I'm saying that correctly, I always get his name wrong, has talked about this a number of times. First of all, Google came out with a translation app a decade ago that was supposed to disrupt Duolingo. And 9 years ago, they updated it. That was supposed to disrupt Duolingo. And these translation apps get better and better and better year after year, and they never end up actually disrupting Duolingo. So what is fundamentally disruptive and what's not? The other thing is, why are people using Duolingo's app in the first place? And you can extend this to any app that you want to talk about. But why are they using these applications? Well, they're using them because they get some sort of value out of them. So in the example of Duolingo, people learn languages for two reasons. They want to get a job in another language, or they do it for fun. Is anybody who wants to get a job, let's say you're I was in Europe recently. So let's say you're in France, you need to learn English to get a job at a restaurant because there's a lot of English tourists in Paris. So are you going to go out and vibe code an app to teach yourself English? Are you going to be wearing AirPods and then hope that the customer that you're talking to is wearing AirPods so that you can then translate to each other like we're at a UN summit meeting? That's just insane to me. And that's the stuff that I think we have to think through as investors is, what is real disruption and what is the market just freaking out and throwing out the baby with the bathwater? So I am trying to look for those opportunities. I think I have a few that I have bought recently in the asymmetric portfolio, but this is just another one of those examples. And the reason that a company like Duolingo could actually benefit from something like artificial intelligence is because of this line right here: research and development costs. So I'll just do this on a trailing 12-month basis. So what you want to see in a company is their operating leverage improving, which means The revenue is rising at a certain rate and their costs are rising at a lower rate. That means that more money is going to be flowing to the bottom line. So the growth, this is since January 2022, so about a 3-year stretch. The growth rate in Duolingo's revenue, 42.3%. The growth rate in their R&D expenses, 34.5%. This is something that I think we're going to see from a lot of different companies in software is customers aren't going to leave because customers aren't going to vibe code a language app rather than paying $10 a month for Duolingo. What Duolingo is going to do is they're going to be able to get more out of the engineers and maybe potentially fewer engineers and programmers than they did before. So those operating costs are going to grow more slowly. Maybe it's even possible that they go, you know what, we're going to be able to increase our user base, but we're not going to charge anymore. So our revenue growth is going to potentially slow, but the leverage is going to be even higher. This is what we're seeing with, I think, layoffs at companies like Amazon. Amazon goes, okay, wait a second, we got 200,000 computer programmers here. We don't need that many. We need, 10,000 really, really, really good ones. And we need to make them 10 times more productive. So that's one way to think about the moment that we're in software is what are the companies that are actually going to be sustainable where customers are buying a product and not code. This is actually something that Ben Thompson wrote about this morning, but that just like kind of clicked a lot of things for me was when you pay for a software product, whether you're an enterprise, whether you're an individual, you're not paying for code. I never look at the code for any of the apps that I use. I'm paying for the product. And that's something that's not easily replicable through artificial intelligence, through vibe coding, through all this stuff that's kind of going through the industry today. So what sort of products are going to be sticky? And then what companies have something like a platform? I'll just pull up another one that I know has kind of gotten hammered recently, and that's Zillow. And if we look at Zillow, they have really improved their revenue growth. You can see they were kind of stagnant through 22 and 23. A lot of that is because of their rentals business. But this is a two-sided marketplace. They build technology, they build a marketplace where people can go and find a home, whether it's a house to buy or a rental, and that they're going to get leverage from that, from having more buyers and more sellers on that same platform. It's kind of a flywheel, especially as some of their competitors have fallen off. But their stock has gotten hammered because it is a software business. Well, what real estate agent is going to vibe code an app that is going to replace Zillow? Look at the stock's down about 20, 25, 30% over the past few months. What real estate agent or even real estate company is going to vibe code an app that's going to replace what Zillow has, which is millions of users going to them on a regular basis. So again, that's where I think we need to think about how are customers actually using these products and where is the point of leverage? Does pricing power go away? Duolingo? I don't know. I don't think they're probably going to lower their prices because other, tools for learning languages are out there. So is there going to be operating leverage because they don't have to spend as much on R&D? Or are they going to have a more valuable platform because they're able to develop more modules more quickly? I think that's much more likely. So I think it's much more likely that their profitability, their free cash flow goes up than that their business is fundamentally disrupted. So that's where I think the market is completely wrong about Duolingo. I might be wrong. I want to be very clear. This is the whole point of having a portfolio with asymmetric investing is I got 20 or 30 stocks. I may be wrong about any of these individual stocks, but overall, I hope that I'm right about kind of the direction of the portfolio. So I think that's just a good way to think about things right now. Brian asked a question. I'll just throw in Brian's question here. What do you think about the potential for gross margin contraction due to artificial intelligence costs? So this would be instead of going from a business model where you're developing something once and you're charging for it numerous times, so you have a lot of operating leverage in those gross margins. A lot of software companies have 70, 80, 90% gross margins. In the world of artificial intelligence, you could potentially have significantly lower gross margins, even if your operating margins or your absolute margin from a dollar perspective goes up. There is potential there for that to happen. And I think it depends on the business. So let's stick with Duolingo here. If you go to some of their higher end applications, if you're actually talking to an AI, and now their cost structure is not just sending you the app. Now their cost structure is, now they have inference costs that they have to actually do that conversation that you're having with the AI. Then potentially your costs go up. But then you do become, the strange thing there is your business does become uh, a little bit less leverage, but there's also potentially lower risk there. So I don't know that we've seen that yet. I think one company to watch would be Salesforce. Salesforce is kind of moving to this agents model today. So is that possibly where we go? Possible. But again, what I want to reinforce here with software and where we are today is take that long term view, take the strategic view, because if you get the strategy right, if you think about what are customers going to do, what are customers' incentives, this is one of the things I think that we're probably, a lot of people are getting wrong with AI today. If a company has a million customers, a million different people aren't going to vibe code an app that is going to replace the thing that they're paying for on a monthly basis. If a company has 5 customers, now your customer concentration risk is very, very different. So just something to keep in mind there. I want to go to some of the questions that came in from the newsletter over the past few days. Let's start with this one. Get this is from. I think this is from Brian. The full question is: as a newer investor, have you considered putting together a checklist of key factors and metrics that you look at for a company? I'd also be curious what ranges you typically find acceptable for things like price to sales, price to earnings, etc. I'm hoping to start taking deeper dives into a few companies on my own, and something like that would be helpful. This is one of these hard questions because it really depends on the industry. And one of the things that I've learned over time is my differentiation over the market, I think, is understanding strategy and incentives and being able to take a long-term view rather than understanding the numbers. I mean, I come from an engineering background. And so you go back to when I really started taking this seriously in 2005, 2006, I would go, I can look up price to earnings multiples. I can look up margins. I can, find all this information, and your edge is buying cheap stocks. The problem is that doesn't typically work. If you, and there's plenty of studies on this, that the way to beat the market is through buying asymmetric investments, through finding the few companies that are going to 10x, 100x over the course of 10, 20, 30 years. So to find those companies, you typically have to look at what's the strategy, not what are the financials, not looking at, and this is where something like computers have completely changed the game over the past 30 years. I bought my first stock in 1995. And at that time, even in 2005, I would send an email to investor relations and I would ask for the annual report. And I remember I would literally get the annual report in the mail. I used to like getting casino company ones because they're really nice looking. I would get like Disney, but you get this, 150 page book that had basically what has currently become the presentation, the earnings presentation for a lot of these companies would be the first, 20, 30 pages explaining the company, giving all the high level metrics. And then the back 80, 90% of it would be literally the 10K. So that's where we were not that long ago. I mean, even 20 years ago, that's how difficult it was to research companies. Now, price to earnings multiple, I can do a screener and we can find all the companies over a $10 billion market cap with a price to earnings multiple over 10 and a growth rate over or under 15 and a growth rate over 10%. And that could be your screener. But that doesn't necessarily mean you know anything about those companies. So understanding what the companies are that you want to buy and that strategically are doing well and haven't reached that inflection point. This is another thing that I think investors often don't quite realize, is that the inflection point from you're losing money to, oh my gosh, you're making a lot of money, is really where the differentiation is. Let's I'll just pull up Spotify here because this was one of the first stocks I covered. It was the first stock I covered on asymmetric investing. And if you look at, this is revenue, but let's look at free cash flow. And let's do it in, let's see. I don't know if this is the best. Trailing 12 months. Okay, there we go. So I covered it, I think it was March 31st, 2023. Revenue was growing, but it wasn't a high cash flow business. And then if you have, net income, which includes things like stock-based compensation, let's see, they were actually losing money. So here's your losses for 2023 into 2024. So if you're looking at something like the price to earnings multiple, that doesn't tell you a lot about what's going on at Spotify. But what we did know in this period of time is they had announced a number of different layoffs. So theoretically, and this is again, AI tools are starting to come out. Companies are starting to figure out, hey, wait a second, we got to be profitable. So if we look at, let's add in SG&A expenses and R&D expenses. So these are your operating expenses. And I'm going to hide these two. Okay, so again, we knew those cost reductions were coming at this time, but they were announcements. They weren't in the financials yet. So you can see that over this period of time, you have about $3.8 billion worth of operating expenses in the business. Today, we're well below that. We're at, what is this, 3.5 or so billion. And so Spotify is significantly bigger. They've got $4 billion more in revenue, but their operating expenses are flat. That's operating margin. I can just pull in that margin number here. And at the same time, actually, their gross margin has improved. That was actually the thing that's impressed me the most with a company like Spotify. So this is their operating margin. June 2023, trailing 12 months is negative 6.9. Over the trailing 12 months today, it's 11.7%. So in 2023, the PE ratio, the price to free cash flow multiple, doesn't really tell you a lot. One of the reasons that I use price to sales multiple more than some of those other multiples like price to earnings and price to free cash flow is because the price to sales multiple at least gives you a baseline of what the top line is doing. And then if you can suss out what's the trend on the bottom line. So if we're going to have something like this and we go from a negative operating margin to a positive operating margin, now I can kind of go, okay, if I'm paying, let's add in price to sales here. In 2023, if I'm paying 2.2 times sales for a company that's losing money, what's the price to sales multiple going to be for a company that's making money and that has a much higher operating margin and free cash flow margin? Well, this multiple, I mean, at the peak, you had a 4x just in the price to sales multiple. So that's one of the reasons I look at those. And then you can kind of go, okay, what are other growth companies? What are profitable companies trading for? Is a 10 price to sales multiple in the future, if this growth rate continues, reasonable? Should I be paying? So, let's look at another one that I've been buying, Hims and Hers. Okay. So now we have price to sales is in blue. Let's take some of these things out of here. And let's just put their growth rate in. Okay. Their growth rate over the past 12 months, 78%. This changes a little bit if you do quarterly, because it's come down over the past couple of quarters. But even last quarter, 49% revenue growth. 49% revenue growth in the stock's trading for less than 3 times sales. From a risk reward standpoint, if we get Hims and Hers compounding revenue at, let's say, even 25% for the next 5 years, this price to sales multiple shouldn't be 3. It should be 8, 10. It might even go to 20 or 30. That's what happened with Robinhood last year. Suddenly the price to sales multiple went to like 25 or 30. That was maybe a little bit too high, but that's where that to me is oftentimes a better indicator of valuation in the kind of companies that I'm looking at than something like the price to earnings multiple or price to free cash flow multiple. So that's the way that I think about it. All of these things are one of the reasons I don't want to hold. I put all of these metrics in the top of every single spotlight I do because they all mean something, but I don't want to over index to any of them individually because none of these metrics on their own tell the full story about a company. And that's ultimately what we're trying to do is build out what's that full story. And to me, the story starts with the strategy. Why is this company going to be the next Netflix, the next Amazon, the next Nvidia in 10, 20 years? Okay, so if I can build that story and then I also have the financial metrics, the financial multiples to back up buying that stock, that's where it's a real sweet spot for me. I've gotten a few questions about Dutch Brothers, the growth at Dutch Brothers. This was like one of those stocks that's just very popular right now. There are areas of the market, and any investor that you follow should be able to articulate this. There are areas of the market that I don't have knowledge. I don't have any sort of way to differentiate what I think about a stock versus somebody else. I have heard this same thing that people love Dutch Brothers, the young people love Dutch Brothers. I'm not really a coffee drinker. My wife loves going to Starbucks. That's really all I know. To me, it's like a comfort food. It's not necessarily something that I'm going to be all that interested in general. So right or wrong, I don't have strong thoughts about Dutch Brothers, but same goes for things like semiconductor stocks. Not my area of expertise. That has been a detriment to the portfolio over the past couple of months because that's where the hot part of the market is. But I'm not the one to add value there. So hopefully that's helpful. I know it's kind of maybe not the best answer for people, but that's kind of my thoughts there. Can you do a deep dive on Trade Desk? Look at the financials in the stock. Is at a 6-year low. The Trade Desk is really interesting because they should theoretically be one of these winners as we get more digital advertising. But yeah, the drawdown in the stock right now is at 80%. There's value here somewhere. And we're getting to a point where I should do a deep dive on the Trade Desk. And it's not an area where I cover a lot and understand all the segments of disruption. But I'll put that on my list of things to do. Might be a good thing to do here on YouTube. Mobileye, got a couple of questions about Mobileye. This is from Sharath, and I think the question is a little bit longer, so I'll read the full thing here. In regards to Mobileye's finances, the company has revenue that's not growing and is very inconsistent quarter to quarter. It's very difficult to understand the business. Also, the operating income is negative most of the time. I do see that's due to R&D expenses. Do you see how do you see the turnaround story, and where's the catalyst going from here to see positive numbers? All right, let's dig into Mobileye. Because this is one of these companies that's a little bit difficult to understand, and you do have to think about 4 or 5 years. My general thesis with autonomy is that this autonomous vehicles are going to be everywhere in 5 years, 10 years. Okay, so if that's from a technology perspective, your thesis, now how does the business play out? And I tend to think this is not going to be a winner take all market. That's always the thesis with Tesla, right? Like suddenly 2 million vehicles are going to become fully autonomous vehicles. I don't think that's going to happen. I think we've sort of proven that with their rollout of FSD recently. And by the way, they have still not, we don't know their safety data. So this is, when I start following these companies, one of the things I used to cover on a regular basis with Cruise and Waymo was in California, they would actually report all of their safety data. So you could go in and see how many incidents did they have per mile, or how many miles between each incident. And you could see sort of the improvement in the technology over time. And then you could even go through and look at each one of these individual incidents. And on Waymo, it was funny because I just started going through them like one by one, and it would be like a sign fell on the car. But that has to be reported as an incident in the state of California. A biker ran into the car, just like wasn't paying attention and ran into the car. That's an incident. So we get a lot of attention for the small number of incidents that happen, and rightly so. And that's going to be the case with autonomy. But even back then, even a few years ago, Waymo was showing that it was vastly safer than a traditional driver. That was before they went onto highways. That was before they expanded into other cities. And I think we've even seen more of that today. The Tesla rollout, which is one of the reason I'm bringing that up is because that's part of the competitive landscape. They have a number of crashes that they've reported to the NHTSA. I always get that acronym wrong. The national regulator, and they have to report those to the national regulator, but they've redacted almost all of the information. So we don't know anything about these incidents, and we know all of the information about other companies who have incidents. So are these major crashes? We don't think so. But are they things that we need to be worried about? Is this gonna be a huge problem if they suddenly turn on autonomy for 2 million vehicles? We don't really have any idea right now. And until we know that safety information and the public is comfortable, I the proof is in the pudding. You got to show your work. Waymo has done that. I think May Mobility is getting there, rolling out some of their vehicles. I think they're in Atlanta right now. I've actually seen them driving around here in the Minneapolis area. Mobileye's technology and strategy. Let's see if I can find the right page here. But what they're doing is a modular approach to autonomy. So they're saying, we're going to develop this autonomous driving system, and then we're happy to sell it to Volkswagen, to GM, to Ford, to Geely. Any automaker in the world can buy our chip, our sensors, our software, and that's the way that the business model works. So I'll just pull this up because this hopefully gives a good overview of what they're doing. Base ADAS right here is what is in most vehicles today. So they sell about 30 million of these a year. I think there's about 70 million vehicles sold annually. So almost half the vehicles in the world today are using a Mobileye base advanced driver assist system. This is smart follow. This is lane assist, stuff like that. The surround ADAS is actually what they had a recent announcement with what did they say it was? Top 10 automaker based in the US. Basically, it has to be either GM or Ford is what I'm kind of pulling from this, because it was also 9 million units. So you got to have an automaker that does a ton of volume and somebody that is based in the US. Putting all those pieces together, I think it's actually GM, but we'll see how this goes in the future. But this is basically just kind of the next level up. So this is kind of where FSD is for current drivers today. You have to be paying attention. If there's an accident, it's your fault. It's not the car's fault, but gives you a little bit more capability. Kind of gives you the ability to have highway, not have to pay attention every second and be actually driving the vehicle yourself. That kind of stuff. So it's going to be a level higher than what we see from the base ADAS system. Supervision kind of takes that to the next level. So we've seen this in a handful of Chinese automakers, I believe, but this hasn't actually been super popular because I think a lot of companies are thinking about what a chauffeur. So this would be hands off, eyes off. So you own the vehicle, but you don't actually have to drive it. You could lay down and take a nap. So I believe this is supervision is eyes off, is hands off, and I think like there's a notification that they have to give you to actually start paying attention to the vehicle. Chauffeur takes it to the next level. This is more like level 4. You still have to be in the vehicle, but there's like a time lag between when the system says, hey, start paying attention, and when you have to actually do something. Drive is there's no driver in the vehicle at all. Okay, so Mobileye, if we go look at their finances, and I'll do their R&D spend, because I think this is probably the most important. So their R&D spend over the last few years has been in developing all of these solutions. So you develop something like Mobileye Drive, you spend hundreds of millions of dollars, but you don't generate revenue for a while. I mean, they're just starting to get to the point where they're testing these at even like a relatively large scale of like hundreds of vehicles. So production of those vehicles isn't going to happen until 2028, 2029. And the drive, the highest level, we're talking about a sale price of probably 20, 30, $40,000 per vehicle because it's an entire system. The announcement that they had recently, if I go back here, here's the top 10 automaker announcement. So more than 19 million IQ6 high based surround system, so that's surround ADAS system, including 9 million from this new automaker. Okay, so they announced a new deal with this automaker that adds 9 million units of backlog, but we're not going to see that in their financial results. If we just go to revenue and kind of the volatility that was brought up in the question, we're not going to see that in their financial results for like 3 years because the lag between announcing something and something actually going into production for an automaker is quite a while. So the data point that I use, and this is from an article that I wrote on asymmetric investing. If you're not a subscriber, I encourage you to subscribe there. There's a free version, and then the premium version gets you access to the full asymmetric portfolio and all my research. But so after this announcement, and this actually came from their presentation at CES, their pipeline is up to $24.5 billion over the next 8 years. So that is about $3 billion per year. But most of that, which is significantly higher than the about $2 billion in revenue that they have today. But it's over the next 8 years. And then most of that ramp doesn't actually start for another 3 years. So in theory, we're already starting to build this backlog of Mobileye being a company that can generate 3, 4, maybe even $5 billion in revenue in 2029, 2030. And they've done all the work to build those products, building the chips, building the software solutions. They have a imaging radar is what they call it, which I think eventually the plan is to have that eliminate the need for LiDAR. So what Mobileye has is their systems are redundant with different failure modes. So you have a camera-based system, and then you have a LiDAR or a radar-based system where the camera is not going to be able to see it very well in snow or fog, things like that. The radar can see better in snow and fog, but it isn't going to be as high fidelity as a camera. So the failure modes are different, and their goal is to get to the point where there's a failure or a critical failure of those systems once every 1,000 hours. So figure 30,000 miles. And they're redundant, and the different failure modes mean you multiply them together. So every million hours, you would have what they would call a critical failure. That's sort of the system that they're building and they're selling to automakers. They've done all the research to be able to sell these systems and start building that backlog or that pipeline. But we haven't seen the numbers yet. And so if the thesis plays out correctly, that every OEM, every automaker is going to eventually have to be offering these autonomous vehicle features, whether it's for individual vehicles or whether it's to plug into an Uber, a Lyft, a ride-sharing platform like that, they're eventually either going to have to develop it themselves, so spend hundreds of millions of dollars to develop it themselves, design their own chips. This is what Rivian just decided to do, despite the fact that they're making 40,000 vehicles a year. I think that's nuts. I think it's much more logical for these OEMs to say, okay, we will manufacture the vehicles, but you do the tech and the sensors, and we'll plug it in. You know, they work together to make it kind of their own system. You don't know it's a Mobileye system when you're in a vehicle. But that's the thesis behind the company, is that, again, your advantage over the market is thinking longer term than most investors possibly can. And Mobileye is a perfect example of that. We know that this stuff is coming. We know that some of these more advanced systems that aren't going to be the base ADAS system. Let me go back to this. And I'm going to get these numbers directionally correct and maybe slightly off. I have this in one of my older articles, so it's been a while since I've pulled all this info. But the base ADAS system, they generate about $50 in revenue per system sold, per chip sold. $50. That's it. You start going up to surround ADAS, now you're talking about multiples of that. So depending on, they talked about this recently, depending on whether they're the tier 1 supplier or they're a tier 2 or a tier 3. They're generating between 100 and several $100 for this. So you're getting, even let's say the volumes stay the same, now your revenue per vehicle goes up by multiples. Start moving up this to supervision, to chauffeur. Now you're talking about thousands of dollars per vehicle for something like chauffeur and drive the entire system. We don't know exactly what the business model is going to be there, but it's going to be probably $20,000 of upfront revenue, and then probably a revenue share in the future as well. That's, I think, what they're discussing with Volkswagen, which is the one that's on the road today through their Moya subsidiary. So the revenue growth potential is there. We're seeing the products actually, the R&D is happening. It's in the field, but we're still a little ways away from this being a significant piece of their business. There's a question about drone companies. Have you looked at drone companies or the supply chain as candidates for the asymmetric portfolio? AMPX, ONDS. I haven't looked at these specific companies, so I'll check them out. The challenge with a lot of the drone companies and the robotics companies in general right now is I don't know who actually has a sustainable advantage. So it could be one of these scenarios where drones, humanoid robots, non-humanoid robots are proliferated on a wide basis in the future, and there's just not a lot of profit there. That's kind of my thesis right now, is I don't know who actually has something that's super differentiated. If like Figure was public and they were worth $10 billion, I don't know if you've seen, if just look them up. They've got a really interesting humanoid robot that, like, they did a demonstration where it took dishes out of the dishwasher and put them back in the dishwasher. That's the kind of stuff I see a lot of value in. A lot of the other things right now I think are kind of pie in the sky. The drone piece, and I don't know those companies specifically, but where there's specific applications like Axon, for example, I think that's a high value use for drones. But consumer drones, just not. We bought a little tiny drone for my son, and it was like, $25. I don't know where there's a ton of value for some of those, but I'll definitely check into those companies in the future. I know there's a couple that came in after we started, so let me get these up here. I know Netflix isn't an asymmetric stock, but wondering if it should be, based on its unfair decline due to the Warner Brothers deal. Two things can be true. Netflix may be undervalued based on the hit from the Warner Brothers deal. And it may still not be an asymmetric opportunity today. I think it could be a good value stock. This is the interesting thing as you go, invest more in the market, is who's the buyer at a certain point. So let me just pull up Netflix's information. Eventually, you're gonna go from growth investors to value investors. So growth investors are gonna be worried about, hey, what's the growth rate of the number of users? What's the growth rate in revenue? Maybe you're worried about margin expansion. But eventually, when a stock starts falling and you start seeing a slower growth rate, and by the way, Netflix, not a super high growth rate, of 3 and 5 year growth rate, 12.6%. That's fine. Do I want to pay 32 times earnings for that? No. Do I want to pay 32 times earnings for a company that is now going to have somewhere in the neighborhood of $80 billion worth of debt? Absolutely not. So this is where I don't think Netflix is in as good a position as maybe some investors do. And my case in point is, why are they buying Warner Brothers Discovery? It seems like a really defensive acquisition to me. That is, they're paying $80 billion for Warner Brothers Discovery. I can buy all of Disney, which is a better studio, has a better streaming service with more subscribers, more revenue, and owns a majority of ESPN. And by the way, most of their money is made in parks. I can buy that company for about a little over double the price that they're paying for Warner Brothers Discovery. I don't see the great value in Netflix today. Definitely isn't an asymmetric stock because I don't think there's 10x potential. But that said, they can still be a winner long term. The thing with asymmetric investing is just because it doesn't fit in my asymmetric universe doesn't mean it isn't a great stock for some people's portfolios. I would love to get a better price. Eventually, there's a no-brainer price for Netflix. I don't think it's at $81 a share. I think it's at like $40 a share. I know that sounds crazy, but could happen. Let's see. Next question that came in from the newsletter. Do you have a view on the currency risk involved in holding mostly US stocks as a EU-based investor? I don't have super strong currency thoughts because a lot of these things typically it's just normal volatility over time. I think Morgan Housel put out a tweet that had the euro to US dollar over the past 30 years, and it's basically gone nowhere over 30 years. I don't know. Does that continue? Maybe. But I think it's something that we probably pay attention to more on a day-to-day basis. Same thing with like gold and Bitcoin being hedges to some of these things. Typically that doesn't work out super well because when the thing happens that you are hedging against, it doesn't have a response. So like, for example, if you're holding Bitcoin or gold as an inflation hedge, when inflation actually hit in, was it 2022? Both of those went down. So it wasn't, it was like it's actually a hedge against the risk of inflation or the risk of currency debasement, not when the actual thing happens. All right, let me put this last one in here and then I will get to some of the questions from YouTube. Why do you think HIMS is falling so much? Is it possible for another to replicate this, like Walmart or existing competition like Roe? I actually have a video that's going to come out shortly after we're done here. I'm going to edit it and get it out shortly after we're done. The headline will be like my top stock to buy in February. And what I think we need to look at with a company like Hims and Hers is the change in the competitive dynamics, especially for a company like Walmart or Amazon, as the incumbents today, as opposed to, especially in the case of Amazon, the disruptor over the past 30 years, basically. So when you have an incumbent, they're typically trying to tack on something like the products that they're selling in the healthcare space to the stuff that you're already doing. Does it make sense that you pay for Prime to get 2-day delivery for your stuff? And then it also then becomes the place to go get GLP-1s? Like that doesn't really make any sense to me. So I tend to think that the companies that are going to focus on a specific problem and find that solution for that problem, especially if the problem is big enough, healthcare, absolutely big enough to be something that a company is going to figure out how to disrupt this stodgy, awful system that we have, particularly in the US. I know the US system. I don't know what the issues are in other parts of the world, but there's going to be somebody who's going to figure out how to do things better. But to do things better, and this gets to the Roe question, I think you have to live outside the existing constraints of the ecosystem. And what I mean by that is in the US, you have to have insurance. And when you have insurance, it creates a whole bunch of really crazy incentives for everyone in the ecosystem. So if you actually go into a hospital and you say, I want to get this thing done and I want to pay cash. People post this online all the time, but this is actually true. And I want to pay cash. They will go, okay, our cash price is $500. And you say, oh, I forgot, I do have insurance. Here's my insurance information. How much is it going to cost? And they'll go, oh, that'll be $5,000. Because the incentives are so screwed up in the entire insurance ecosystem. If an insurer can only make more profit by spending more, the incentive is for them to spend more. And that's where that cap with, this started with Obamacare. An insurance company can only make 20% of their revenue as profit. Just do that formula. How do you increase your profit? You increase the amount that you spend. Yes, you want to increase your revenue, but you have to increase your spending in line with revenue. So the incentive is for costs to go up for everyone involved, for doctors, for pharmacies, for insurance companies, for everyone. The incentive is for costs to go up. Whose incentive is it for costs to go down? It's a company where they see opportunity to disrupt the status quo. Hims and Hers has talked about, and I've written on the newsletter about the fact that they are living outside of the insurance system. They do not accept insurance because then you start bringing in all of these crazy incentives. So if you look at Roe's gotten a lot of attention recently because they have the Wegovy pill. That's cool. They won that. But then you look at what their actual cost structure is. Their monthly membership is $145 a month. And then you pay for whatever subscription you get or prescription you get. So the pill I think was $200 to $300. I have it in the video. But your ultimate cost is like $300 or $400 a month for this Wegovy pill. Same thing with GLP-1s. You're paying almost double what you would pay through Hims and Hers for GLP-1s. And this goes across all kinds of different product categories. So ultimately, if a consumer is actually making a choice and not an insurance company making a choice, what choice are they going to make? They're going to make a choice to go with the low-cost provider that has a good solution, a good technology solution. And that's where I think the opportunity is for Hims and Hers is if they can get enough customers to adopt their platform or be on their platform, then they will be that aggregator of demand. And you do that by having a good technology solution and a good app. I don't think we're there yet with them. They started as an ED pill and kind of like Wild Wild West with ED, for example. There's been plenty of criticism with them for compounding GLP-1s. By the way, you actually look, that's not all that uncommon. They're just doing it at scale. That's what I think the pharmaceutical companies are worried about is like compounding GLP-1s is not unusual for a doctor to do that. Doing it thousands or hundreds of thousands of times is maybe a little bit different. So that's why I think that, the industry is looking at them a little bit differently and the risk is a little bit different. But if you're building an app, the customers trust you and you have your lab information, I think eventually they're going to pull in all kinds of things like I'm wearing a Garmin watch. So this Garmin watch tracks how I sleep every single night. It tracks, now with some of the Garmin apps, you can track what you're eating. It can track my weight. I've actually got a Garmin scale yesterday. So I want to be able to start tracking all these things. And where does that information go? Right now, it doesn't go anywhere. But they are talking about building the ERM, I think it's called, where you would keep your medical records, EMR, where you would keep your electronic medical records on Hims and Hers, and then they can track what is happening to your body on a day-to-day basis. And so, like, let's say we get to a world with peptides where you get prescribed a peptide, and you can go over to listen. Huberman has some interesting podcasts about peptides, but this is a really interesting area of research and advancement. They bought a peptide facility last year, but it's very different from going to a doctor saying, I want to lose weight. And then the doctor giving you a prescription, and then you going back 6 months later and the doctor saying, did you lose weight? How did this go? And then you're going, here's what went well, here's what didn't. Those are single data points in time. The advancement, what technology brings disruption to healthcare is now instead of being these single discrete points of information, now we can track these things over long periods of time. So you can track, my sleep is getting worse. Why is my sleep getting worse? What changed? Did I take a new medication? So can Walmart think like that? Can Amazon think like that? Amazon's probably a better place to go to get, antibiotics when my kids get sick. But it's probably not a better place to think about longevity, which is something that Hims and Hers is going to be launching in 2026. So again, this is what disruption is all about, is thinking about things completely differently and breaking down the old infrastructure. That's why I think they're still in a really good position. And that's why I think they're so different than Roe. Roe is slotting into the existing insurance infrastructure because that's what that $145 monthly fee covers, is all the insurance BS that they have to deal with. Hims and Hers says, you know what, we're out. We're outside the insurance ecosystem. If you want to go with us, we're lower cost. So an example of that working out really well is something like LASIK. Except you can't do LASIK at scale but Hims and Hers can do, pharmaceuticals, medical tracking, all that kind of stuff at scale. That's a long-winded answer. There's a lot of unknowns, but I like companies that are looking to disrupt a huge industry and thinking about it completely differently. And the little data points that I love is when the incumbents get really pissed at them, when they get really upset that, hey, wait a second, what are you doing? You shouldn't be able to do that. All right. What are your thoughts on AMD? I'll get to some of these questions coming from YouTube, and I think there's some from Twitter as well. I don't have great thoughts about semiconductors. Jose Najarro, Nick Rossalillo do a really good job with those. It's just not my area of expertise. That's one of those areas where I think you need to focus on semiconductors if you want to know exactly what's going on. That space. Have you come across MRAM? No, I have not. Emerspin Technologies. Stock's gone crazy. They are. I'll just pull this up just to give you an idea, kind of how I look at these companies initially. Stock's gone crazy. Revenue growth hasn't done much of anything. Am I on trailing 12 months here? Let's do trailing 12 months. Okay. I don't know. I'll keep this up and look at it, but no, not a stock that I have looked at. Thoughts on Ethereum mid and long term? I'm going to say the same thing about Ethereum and a lot of these cryptocurrencies that I've been saying for going on probably close to 5 years now. I think there's a lot of disruption that could come from the blockchain. I don't understand any of these specific tokens. Why does Ethereum have value in the future besides someone else buying Ethereum? That's like buying gold. I think that's the same thing what Bitcoin's in right now. Why is Bitcoin down? Because I don't know, because the buyers of Bitcoin evaporated. And MicroStrategy stock declined, and they were the biggest buyer of Bitcoin. So the price falls. We make up stories for the reason that things are going up, but things are just going up in the crypto world. Things are going up because people thought they were going to continue going up. Ethereum, I know that there is a use case on the blockchain. You have to use Ethereum to validate transactions and things like that. But ultimately, I don't know why that's a huge asset. So it's not an area that I am investing in. I think I have a little bit from legacy, just kind of learning about what's going on with the blockchain and how to buy stuff and all that kind of stuff. I'm much more interested in the companies that are using that blockchain to disrupt existing companies. So like the Coinbases of the world. Figure is one that I have on my short list. I actually started a spotlight article and then the stock went crazy, starting to come down. So maybe you'll see that one in the future from me. But like Robinhood, SoFi, they're thinking about what does the blockchain look like for us? How does that help us in the future? I think it's going to be disruptive to things like payments. I mean, Visa and MasterCard, these are stocks that I sold years ago thinking that it's crazy. If you've ever owned a business, you pay about 3% of your receipts. So if you pay $100 for something at a restaurant, for example, you pay about 3% to complete that transaction, and you don't get the money for a few days. So you get $97 and you get it in a few days. So is that transaction fee worth it when it is now a digital transaction? Like you're just tapping your phone. What does it matter whether the rails are a credit card or a blockchain? The problem a few years ago was that we weren't at the point where it was trivial to break that connection between the credit card company, and switch over from a credit card to blockchain. Now it's a lot more trivial. So you have companies like Stripe where you can just pay with USD, and I think we're moving in a direction where you're just going to have USDC or SoFi USD, whatever you're going to have in your SoFi wallet, in your Robinhood account, and when you pay for something, you're just going to pay for it. With stable coins, it's going to be a cheaper transaction. And now, by the way, those little fees you're starting to see show up where they say, hey, if you want to pay with a credit card, great, but we're going to charge you 3.5%. Those are going to start going away because there's an incentive for everybody involved to cut out that taker in the middle, which is the credit card companies. There's also all kinds of other things that you can do, like get rid of, like housing was one of the examples that I used when I wrote the Coinbase Spotlight like 2 years ago. why are we doing a housing title search? Why isn't the title just on the blockchain? You can see like, oh, it's in Travis. Travis owns that house. There's all kinds of disruption that's coming, but it's going to be those infrastructure companies that I'm really interested in, like Coinbase, other than the application layers, which would be the SoFis and Robinhoods of the world. Maybe they play a little bit in infrastructure as well. I think I talked a little bit about Duolingo earlier. So if you want to go back and look at exactly what I said about Duolingo, this is probably one I'm going to keep covering on a pretty regular basis, because I think that the market has this completely wrong. I may be wrong. I just want to be clear on that. Like, this is my thesis. This is what we're doing as investors. We're taking a risk because there's a possibility that we're not wrong. But I think disruption is not really coming for Duolingo because of AI, because who's vibe coding their own Duolingo app? I think that's just kind of crazy. What do you think of the BRICS effect could have on the U.S. economy and stock market, and what time frame as China expands worldwide? The BRICS effects. I assume you're talking about Brazil, Russia, India, China, South Korea. Is that BRICS? You're talking about macro, which I don't cover a lot. So one of the things I think is tough if you're looking at macro impacts is a lot of times things don't, the result is not what you think it would be. So if you're looking at like political impacts, you go, oh my gosh, Obama was elected, the stock market is going to be awful. You can go back, and there were people who sold, like the owner of the Dolphins sold the Dolphins because he was worried that Obama was going to raise taxes. That was the dumbest thing he could have done. We went into like a 15-year bull market right after that, because a lot of times your initial reaction of what you think is going to happen is not actually what's going to happen. So, China is expanding worldwide. Yeah, that's been happening for 20 or 30 years. That's going to disrupt a lot of different things. That's why we have to think about the strategic place that each one of these companies is in. I'm still not very interested in investing in a lot of these companies or countries, because I've been burned by China investments. It's not the US. So I don't have a great answer for that, but it isn't something that I think is going to change a whole lot that hasn't already naturally been changed over the last 20 or 30 years. Things ebb and flow. Some manufacturing is going to come back to the US because manufacturing just simply got more expensive in China. It's not just because of tariffs. When I saw this back when I was in my engineering days in 2007, 2008, when we were doing product development, and stuff was super, super cheap to get made in South Korea or in China. Now it's not as inexpensive, especially with things like shipping costs. So maybe not a satisfactory answer, but I tend to not worry too much about the macro, because oftentimes where you think things are going because of some sort of event or political move or whatever is oftentimes the opposite. And that if we cloud ourselves with some of those things, and I'm just putting macro in a big bucket there, it can be not helpful for us as investors. Grab is not one that I look at. I get asked about Grab on a semi-regular basis. Grab is headquartered in Singapore. I have never been to Singapore, Cambodia, Indonesia, Malaysia, Myanmar, or the Philippines. I don't know how I'm going to give good analysis on what's going on at Grab if I physically can't use the product. What advice would you give to new investors to look for growth stocks or dividend stocks? It really depends on what your goal is. So, I can't give individual advice here or on the newsletter, but if you're a new investor, you're young, typically growth stocks are going to outperform dividend stocks long term. One of the things that I have written about, I need to rewrite some of these older articles that I originally did with asymmetric investing, but one of the reasons a lot of dividend stocks have underperformed the market over the past 20 or 30 years is that a lot of them were built on a supply-based economy. So, this is a longer conversation, but if you look at the Procter and Gamble's, why did the Kraft Heinz deal not work out? Budweiser, Coors, any of those big brand companies that seemed like they were just printing money year after year after year, in the 80s, 90s, 2000s. What happens then in, about the time the iPhone comes out? Well, the internet is proliferated everywhere. Now you have businesses where shelf space is not the constraint. And the story that if you watched me before, you've maybe heard this story, but I knew somebody who was in beer distribution, and they were a Budweiser distributor. And so they would go into a bar, and if there was a new tap from, let's say, a local brewery, they would go, how many kegs of that do you sell in a week? And they would say, one or two. How many kegs of Bud Light do you sell? Go, 7 or 8 a day. Okay, if you want your delivery of those 7 or 8 kegs of Bud Light, you're going to take that tap off. That was the power that distribution had in the 80s, in the 90s, all the way through the 2000s. Then something flipped when we went to a world where, you know what, maybe Kraft is not the best cheese. Maybe Heinz is not the best ketchup. Maybe I want to seek out something that's a little bit different. So now those companies that just sold the big box brands, now they went, you know what? If you want to take, I mean, like, Whole Food, the growth of Whole Foods, I think is interesting in this because they didn't have a lot of those big brands, so they were able to take market share, and then suddenly Target or your local grocery store starts going, okay, like, we got 18 different ketchup options and mustard options. If you want to take Kraft away, fine. Like, we don't care. And so you started to see things creep in, and that was because of the internet. The awareness for these niche products just got better and better and better. And so a lot of those companies, which are dividend paying companies, the dividend kings, the dividend aristocrats, whatever you want to call them, they just kind of didn't go anywhere. They didn't grow. They didn't, a lot of them now have cut their dividends. I mean, if you're paying your dividend for 120 years and then suddenly you're cutting your dividends, something fundamental has changed. And that's what's changed about a lot of these dividend companies. So if you're looking at dividend stocks, my caution would be, make sure you understand why the business is better 5 or 10 years from now than it is today. If you don't have a good answer for that, then it doesn't matter what the dividend yield is, because it's just not going to be sustainable. What do I think about MSTR? Is that still what their ticker is? Now called Strategy. I think it's a Ponzi scheme. I think I've done videos on this in the past. You can look up Travis Hoyam MicroStrategy. The whole thing doesn't make any sense to me. Selling stock to buy an asset that can go down in value, you have a ton of risks there. Typically, those stocks trade for a discount, not a premium. So typically, if you're buying gold, for example, you wouldn't trade for a premium because you're buying gold, because investors would just go, I can just buy gold. Why would I want to buy gold through you and pay you a fee? Same thing with MicroStrategy or strategy. Well, if you want to buy Bitcoin, just buy Bitcoin. I don't know. I don't understand why we're buying. And the whole thing falls apart if their net asset value is higher than their stock, than their enterprise value. So the whole thing, it made a ton of sense for them to be buying more gold, have Bitcoin yield. Again, something I did a video on a while ago that I helped show what the definition is. It's just kind of a crazy concept. If that turns negative, the whole thing falls apart. So beware there. Good day from Australia. Can you see generative AI disrupting the need for Adobe services? Kind of. I think where I'm at with Adobe, and I did some negative videos on Adobe like a year or two ago because the stock was really expensive. And what I didn't understand with Adobe at that time, and I still think this is probably true, is how does Adobe have more users in the future than it has today? So I use Canva, for example, for for making images and thumbnails and things like that. Why would I ever use Adobe? Like, there's a whole learning curve. I don't need to be a professional graphic designer. So there's really no need for me to learn Adobe. I use Descript for editing videos. Another tool, it's for dummies like me. If you're going to make a blockbuster movie, you're not going to use Descript. You're going to use, probably an Adobe tool. But is the number of people using those Adobe tools, because they're charging per seat, is that increasing? probably not at the pace that it was. So if you look at their revenue growth today, most of their revenue growth is from increasing prices in their products. So I think Adobe's in the case where they're a very sticky product. It's a industry leading product. You still, I'm sure, learn it in graphic design schools. One of my friends was a graphic designer, and they just live in Adobe. But if that's the case, then that stock should be trading for, we're at 15 times forward earnings, 18 times trailing earnings. That's pretty fair. Maybe this wouldn't be a no-brainer buy to me until you get to like 10 times earnings. Does that sound crazy? Sure. You know what you could buy for 10 times earnings a little over 10 years ago? Apple. Like, these things happen when companies go from growth companies to, ooh, are we going to be stagnant now? Then the market throws them out, and you can often get them at really good prices. So Adobe does become attractive at some certain price. I don't think they're going to be they're not going to be destroyed by artificial intelligence. But I think the addressable market for Adobe is probably not getting bigger. So hopefully that's helpful. Have you looked at Pagaya? I have no idea if I'm saying that correctly. No, I have not. I'll add this to my list of things to look at. There's so many stocks out there that I cannot keep up with all of them. I think the biggest use case for Ethereum and stablecoins and tokenized assets, possibility to disrupt the payment system is huge. The Ethereum is the top layer for that infrastructure. Ethereum's really expensive and really slow. So I totally disagree. If we're going to be building all the stuff that you just said, Solana would be the place to do it, not Ethereum. Which IPO in 2026 are you most excited about? SpaceX, Canva, ChatGPT, or OpenAI, I guess would be the one there, or any others. I have no interest in SpaceX, XAI, or OpenAI. Companies coming public at $1 trillion valuation is insane, especially when those companies are not profitable. None of those companies are profitable. Canva, we don't know if they're going to come public or what the valuation will be or what their financials look like. So I'm not interested in any of them initially, and show me that you have a sustainable business model would be my answer there. I'm going to give you one. I'll give you two cautionary tales here. First one is going to be Figma. Remember Figma? So Figma IPO'd and hit, I forget what their price was. I think it was like for $35 a share was the actual IPO price if you could get shares at the IPO, but $122 per share. This is August 2025. So less than 6 months ago, exactly 6 months ago. The stock is down 80% since then. Figma is essentially the exact same company that it was 6 months ago. They were going to get acquired by Adobe for $20 billion. Now they have a market cap of $13 billion. It is okay to not buy an IPO and just let the market figure out what the clearing price is. And oftentimes you get these instances where they just completely tank. The other one, Circle. So again, if you know Circle, they run the USDC stable coin. If you want access to the USDC stable coin, a better place to get it is actually through Coinbase. But again, I've got some videos on that. They hit $263 per share a couple of days after they IPO'd. That stock is down 75-80% since then. Don't think that you have to jump into these IPOs right away just because they're a hot stock. Wait for these to be a little bit more of a no-brainer. Circle is much more compelling at a $16 billion valuation than it is at a, what would that have been, $60 billion valuation? I didn't think that made sense at the time, but do you think the market's not quite factoring in the income from prediction markets for Robinhood? The income will be 2x going forward now that they bought the MIAX exchange to host their own event contracts. Robinhood's really tough. So I sold a little bit of my Robinhood in early January. The valuation, I think even then it was like 25 times sales. And the stock had just gone crazy. One of my huge winners in the asymmetric portfolio. I still one of my bigger positions. Is the market not quite factoring in? I think the market's probably factoring in all this stuff. The question is, when do we hit some sort of wall with growth where the company doesn't grow 100% a year? Um, and the drop in the crypto market is right now something that's hitting Robinhood. Their reliance on some of the crypto stuff, I think, is one of the things that kind of made me go, maybe this multiple is a little bit crazy. But let's go to their segments and KPIs because then I can pull in the revenue from each one of their major segments. And the interesting thing is just what's happened to the company over the past few years and how they've evolved. So if you go back to 2022, even so, the bottom of the market for them. By the way, I know that Robinhood's been growing lately. Robinhood's revenue can fall. So it is possible that we go from a point where they're growing 100% a year to they're negative because they do have a very volatile user base. I mean, I use Robinhood, I like their products, but they do have a user base that buys a lot of options contracts. That's doing a lot of prediction market activity. That is not something they have some sort of huge moat around. And they don't make a ton of their money on things like equities trading or just holding cash in your account, something that like a long-term investor would do. And the value of an average Robinhood account is still only, I think it's about $10,000. It's not Interactive Brokers or Charles Schwab where it's $100 or $300,000. I forget what I mean, but those are multiples bigger. So the business is just naturally more volatile than it is with some of these other companies. Okay, so that out of the way. You go back to 2022, their biggest segment was options revenue. Okay, that has about doubled over this period of time, but it is not their biggest segment anymore. Their biggest segment is net interest revenue. So that's going to be the launch of the gold card is going to be the biggest driver of that. Phenomenal credit card. If you don't have a gold card, 3% cash back, just put it straight into your brokerage account. It's a great way to accidentally save money every single month. But this is the maturation of Robinhood's business. And cryptocurrencies, the other thing, this could go from $1 billion in revenue over the past 12 months to look at where we were in trailing 12 months, 2022, $200 million. So that could contract. Is the prediction market going to be, I mean, it should be basically 100% margin because they're not really taking any risk there. But is it fundamentally something that's going to drive the business forward? I just don't think it is. And if it is, that's a different concern for me. Because I don't really want Robinhood to become DraftKings. That's a crazy business or a totally different business. So I don't know. We'll see what happens. We'll see what the numbers look like. I think they're making a lot of the right strategic moves. The valuation is going to go up and down. And this is another stock that, it's $88 a share now. It could definitely go down again, to another 50% or whatever. I'd probably be a buyer there, but prediction markets, I don't think is something that's going to be super surprising for the market. What's your take on critical minerals, rare earths, like USAR, CRML? Thank you. I'm not touching any of that stuff with a 10-foot pole. You can go back to, I wrote probably 100 articles in the, what would it have been, 2014 timeframe about rare earths. First of all, they're not all that rare. I think that's commonly known these days. But the other thing is, they are a supply and demand business. So in moments of high demand, the prices can skyrocket, but then somebody always comes in with a bunch of supply. So sometimes like Molly Corp, I don't know, Molly Corp was a hot stock. Did they go bankrupt? And who are they now? They are somebody now. They're one of these companies now. Trial for Chapter 11 in 2015. I mean, that was one of the hottest stocks in the market. Yeah, that's MP Materials now. Right? Yeah. Anyways, that Sabine Pass mine has been a dozen things over the past 15 years. These companies come and go. It's just it's a commodity business. These products are replaceable. So if the price of one rare earth goes up, you just reformulate your magnet to use something else. This is just what happens at companies. So I'm not really interested in taking the risk on any of those companies because I don't think any of these companies has a sustainable, durable advantage. So, and you can look back at what happened to Molly Corp as a perfect example. One of the hotter stocks on the market back in probably 2013, 2014, and then went bankrupt in 2015. What are your thoughts on TSMC for 2026? Valuation seems so low related to growth, their moat and their demand. And if China invades Taiwan, then everyone has bigger problems. I think that is 100% true. Let me just pull up some of their numbers here. Yeah, if you could like go long Taiwan semiconductor and then just go hedge it with like a short Apple, would be probably good if you're a hedge fund. That'd probably be a good trade. I don't love Taiwan Semiconductor here, to be honest. They are investing a ton of money in building out their capacity, and eventually that capacity is going to be overbuilt. You know when I loved Taiwan Semiconductor was right here. Let's look at the, and again, I like that there is you can go back on YouTube and see my videos on Taiwan Semiconductor. Their price earnings multiple in November 2022, this is after ChatGPT came out, was 11, 12. You could buy it in September 2023 for 15 times earnings. You could buy it in April 2025 for 20 times earnings. We're now looking at 30 times earnings. They've had a lot of growth. They've had a lot of tailwinds. They've been able to pull price from a lot of their customers. I'm not saying that they're in a bad position in any way, but we're now moving from a phase where they're extracting more from their customers because they can. They have that pricing power, to everyone in the world is building as much semiconductor capacity as they possibly can because prices and margins are so high. That is why this is a cyclical business. Let me just pull. Let's take price earnings multiple away and go with. Now, Taiwan Semiconductor is less volatile than most semiconductor companies, partially because they used to run their fabs forever. But 2017 through 2019, not a lot of growth here. Then you go to this high growth phase. Remember when this was when demand exploded for PCs and smartphones? Negative in 2023. Now we go back to high growth again. Is 2027? Don't think about 2026. We kind of know what's going to happen there. When you look at 2027, 2028, do we go to a point where now revenue growth is negative? Now margins are maybe coming down. That's where you have to look at where you want to buy stocks is when revenue growth, margin expansion, meaning the margins are going to go up in the future, and multiple expansion are all tailwinds for you, not headwinds. I don't want us to own a stock that goes from a 30 price to earnings multiple to a 10 price to earnings multiple. I want to own a stock that goes from 10 to 30. So I think we're in the opposite place right now. Everybody knows semiconductor demand is super high. Everyone knows that memory prices are super high. Everyone knows that CapEx is going up, blah, 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 blah. This is how you get bubbles because everyone knows that. Everyone's investing in it. Everyone's putting billions and billions of dollars of work. All these stocks are super high. Eventually, we go, holy crap, we got too much capacity here. That's why they call these cyclical companies, because they're cyclical. So, no, that's not an area that Taiwan Semiconductor, I think, is one of the best run companies in the world. There is a price that I would love to own that stock. It is not the current price. Mercado Libre. I know a little bit of Mercado Libre, despite the fact that I broke my rule where I've never used Mercado Libre, but I know enough companies I know enough people who lived in South America that were like, hey, they own this place. So is it undervalued? I don't have a great answer for that one today. Thoughts on Adobe. I just talked about them a little bit. So Zupaka, if you want to go back in the recording, I guess that came in a little bit. So it'll be about 10 minutes before you ask that question. And I talked a lot about AI and all that stuff. So hopefully that all answers your question. But yeah, go back in the recording about 20 minutes from where we are today or right now. Has I think this is the last one I got in the queue. So if there's anything else quick, get them in. Just joining. Has Spotify been disrupted yet? Not sure what to do with my position. Um, sold a little bit of Spotify in January. I don't love the fact that their growth rate is slowing. And it seems like the biggest lever that they can pull right now is price increases. Because eventually, I mean, like you look at Apple One is bundling a bunch of stuff together. It isn't necessarily related, but it includes music. Does that suddenly become compelling for somebody like me and my family because it includes music as opposed to paying for Spotify individually? Maybe eventually. So there's limit. The problem with Spotify's business has always been there's sort of limits on the levers that they can pull. I showed the chart earlier about their operating leverage. So when they got to a certain valuation, and I think the market didn't understand what was going on with them, I saw the upside. A lot of that is played out. So where do they go next? Advertising has been pretty disappointing for me. That's an area where I thought they had a lot of opportunity to grow, expand revenue by expanding that market. So now you could get into people who don't pay for Spotify. You monetize them the same way through ads. They have not been that effective. Then you can move into things like video. You can move into podcasts. There's all kinds of ways you could grow the business if your ad business works. Their ad business doesn't work that well. So that's one of the reasons I'm a little less bullish on Spotify. And let me just look at their multiples quick. They're not the cheapest stock. Yeah, forward PE multiple is 44. Forward price to free cash flow is 28. That's pretty expensive. So I still like the company. I still think they're going to grow. I think Danielak probably walked out at the peak. And then goes on to say, yeah, I love the product. That's why I'm hanging on. Totally agree with that. Samsara on Toast. I don't know Samsara. Toast, I'm getting more interested in. Little backstory. I actually had a business that used Toast going back to 2017. So very familiar with Toast. But it was always, very, very highly priced after they came public. So now we're getting to the point where it's on my radar. These payment companies, some of them are pretty sticky. And if you look at Toast, it's not really the payment side of it that I'm interested in. It's the subscription side. I mean, this is how you run your business, and it's very valuable. Restaurant owners are happy to pay, whatever the subscription price per month is for those handsets to be able to make your entire business more efficient. So yeah, being dragged down with SaaS. I got to look at, yeah, we're at $18 billion market cap, still a PE multiple of 31. I don't know. I want to get it for cheaper than that. I'm getting greedy. We're going to get to a point here, everybody. If you are new to investing in the last 16 years, we are going to get to a point where some of these companies are going to trade for multiples that you thought were never possible. And you're going to feel really stupid buying them because you're going to think the market knows something that you don't. And that's how you get asymmetric returns. Speaking of PayPal down 20%, good time to buy. I don't live in the US, so can't judge future potential. PayPal, I think I'm down 70% on my shares of PayPal. I think it was cheap when I bought it. I don't know. I've just kind of stayed away from that one because I don't know what the market wants PayPal to do, and I don't know. But at the same time, it's just not all that inspiring of a company to me. Coinbase entry point. I'm assuming the question is related to is the current price a good entry point? I'll just pull up the chart here. I mean, I can't give personalized advice, but I think I bought shares in either December or January. So a little bit higher than where we are today. Long term, this is one of those companies that I think is very, very well positioned for disruption coming from the blockchain, but doesn't mean it can't go significantly lower. In 2022, the stock traded for $32 a share. That's still a pretty significant drop from here. Price earnings multiple on a forward basis is still 42. Enterprise value to sales on a forward basis is 9. It's not a no-brainer price, but I'm much more interested today than I was at 350. Investing in SaaS stocks should not be done this year. What do you think? Depends on the company. I mean, if you want to go back to my little rant to start this, I think we're seeing some really good opportunities in some of these companies, but you have to understand what's going on with the company. What's the strategy long term? Is there some sort of moat, whether that's, they're aggregating demand, they have a platform, there's network effects, those kinds of things. Different companies are going to face different competitive pressures from things like artificial intelligence. So not all SaaS is going to be created equal. SPGI, is this just the S&P Global? Am I getting that right? Not a company that I've really looked at. These data feeds are, I guess I don't have strong views. Some of the data feeds from some of these companies been a lot of wrappers kind of built around some of these. I don't know that that's necessarily a great business long term when things like artificial intelligence can pull all of that information from the source itself. So I don't have really a strong view one way or the other. All right, last one here. Not optimized for earnings, operating leverage for both. Brandon, was there? For Samsara and Toast. I think that was in relation to that. Yeah, that could be fair. So like I said, I don't know Samsara. I'll look at that one here and familiarize myself a little bit. Toast, the reason I like them is, operating system for restaurants, and everybody goes to restaurants. Strange headwind there is we're hearing more and more that GLP-1s are a headwind for basically everybody in the food industry. I think even Starbucks talked about that. Sounds crazy, but even a couple percentage points of growth lost from things like GLP-1s is opportunity cost for them. The question about eVTOLs, you can go back and look at. I've got content on Archer and Joby, both on the newsletter. Joby is one of the stocks that I own. It's a long road ahead. It's gonna be really volatile. I think we're gonna be, our family's gonna be hopping in a eVTOL to fly to Chicago in the distant future. Maybe that's 10 years away, maybe it's 20 years away, but that's the kind of stuff that's really exciting. But how do you analyze those companies? It's got to be a little bit speculative because they don't have a lot of revenue, or they definitely don't have any earnings, all negative cash flow right now. So like where they're going, but not big positions. All right. Thank you everybody for joining this AMA. I'll continue to do these once a month. If you're not subscribed to the Asymmetric Investing newsletter, that's kind of the core of what I'm doing. And that really helps support all this work, whether it's, these videos that I'm doing on YouTube or anything else that I'm doing and putting out there. Those premium subscriptions, really help. And, doing my market beating portfolio there. So hopefully it's a value add for everybody that's getting that research and, taking what I'm doing with my portfolio and my money and building that portfolio over time. The way that the asymmetric portfolio works is I invest $500 a month. Nope, that's not a ton of money, but the point is that it's an amount of money that should be attainable for a lot of people. So if $50 is right for you, if $5,000 a month is right for you, you can scale up and down in the way that is appropriate for you. And then you're seeing what I'm doing with that money. What am I buying? How am I thinking about these companies? When do I sell? Which is rarely ever. I want to default to never selling. So I'm showing you my work and how I'm building this portfolio over time. So that's the entire thesis around everything that I'm doing. And that's kind of the biggest output. But hopefully everybody's getting a ton of value from that. And if you are not a subscriber, I appreciate everybody that checks out Asymmetric Investing and becomes a premium member there. I will be back at least in a month with another AMA. May try doing one of these mid-month for premium subscribers, both there and also on YouTube here. But we'll see. We'll see if there's demand for that. Thanks everybody for watching. We'll see you next time.